advisor with the Strathmore Group and a mortgage industry and technology evangelist. We really appreciate you joining this important discussion that we're having today. I think we all know that the industry has been, let's be honest, a little bit brutal, especially over the last couple of months. And IMBs, brokers, and everyone else alike are dealing with some stress and some confusion. So luckily, the California Mortgage Bankers Association and Mortgage Innovators are tackling the issue head on by inviting the very best that our industry has to offer. And we're going to be asking them questions that you've submitted, covering some very tough topics, including the cost of doing a loan, the ROI on automation and tech, staff changes, and of course, the best things that loan officers need to be focused on right now to finish 2022 strong. So before we get into the panel discussion, let's take a minute and introduce our esteemed panelists.
My name is Alex. I'm the co-founder and chief visionary officer here at Sales Boomerang Mortgage Coach. And what we do here is we identify everyone in your database that's ready for a loan and then align them with the best possible strategy that's delivered through a digital presentation. So no borrowers left behind, and you're always a financial friend.
Hi, I'm Dewar Alimi, CEO and co-founder of LenderPrice. We're a mortgage pricing engine that serves lenders of all sizes. We have a product called Marketplace 2.0 and also called M20 that serves brokers and wholesale lenders. And we also have an enterprise pricing engine that serves IMBs, banks, and credit unions.
Hi, I'm Josh Fent, CEO and founder of Accelerate. We help lenders close more loans with our CRM, our engagement platform, and our new Agent Connect product.
Hi, I'm Laura Martel, Executive Vice President of Mountain West Financial. We are an independent mortgage banker located out of Southern California who's focused on purchase money lending.
Hi, I'm Michael Guidotti, SVP of Production with American Pacific Mortgage. We're a top 15 national IMB.
Hi, I'm Shashank Shekhar. I'm the founder and CEO of Insta Mortgage. We are a tech-forward independent mortgage banker named the fastest growing mortgage company in America.
Okay, now that you have met this wonderful group of panelists, let's waste no more time and let's dive right in together. Our very first question is coming from Tim Anderson at Evolve Mortgage Services. Hey, Tim. So the question from Tim is, despite major investments in AI, RPA, machine learning, blockchain, etc., technology, the cost per loan is the highest on record at $10,937 per loan, which I think is the latest numbers from MBA indeed. So Tim is asking, how come after all these years, technology still has not made a major impact to those bottom line costs? So I know we probably have a lot to say about this, but Dewar, I'm actually going to turn to you first to lead us off on this one.
Yeah, no, thanks. I think this has been a topic that's been asked at several conferences. I mean, the price just keeps going up. But if we look at AI, RPA, and machine learning, these are often touted as game-changing technologies that have the potential to revolutionize the entire industry. But while there's no doubt that these technologies have transformed some of these industries, it's important to remember that they're still in their infancy here servicing the mortgage industry. AI and RPA are often used to automate repetitive tasks, such as data entry and fraud detection. However, these technologies have not yet been fully integrated into the entire mortgage origination process. So as a result, the cost per loan remains high. However, its adoption has been very low to concerns about security and scalability. Ultimately, it'll take time for these technologies to fully mature and make a significant impact on the bottom line costs.
Well, we also talked about the fact that, right now with the decline in volume, that doesn't help because there are certain fixed costs that are there, right? And so that makes this number maybe look a little bit artificially high. However, still is a question a lot of lenders have been asking, just like Tim. So Michael Guidotti from APM, I'm going to turn to you to weigh in a little bit with your thoughts on this.
Yeah, I think Dewar hit a key point when he said, the infancy of their existence, right? Because one of the things that we've experienced too is, some of these great technologies and great, machine learning and AI that we have, we can only apply it to certain loan types out of the gate. So what we found is even certain things that we've rolled out, you start and you're only able to apply it to conventional loans. So you're not getting that pickup on maybe the FHA side or the DPA side or these other that make up, for us, a high percentage of our volume. So you're having to start at a very controlled and concentrated kind of, focus on what loans, what type of borrowers, what type of income, you can use it on. And, so I think over time, we're going to see that obviously increase, which is then going to, lower the cost that it's, impacting us per loan. But I think it's right now, we're having to have such a singular focus on a lot of these, technologies as they roll out. And it's also then increasing the amount that we have to use, right? We're having to use one for this thing, something else for this, and there's very few that are doing it all.
Shashank, I think you were kind of nodding your head a little bit there. You want to share your thoughts on this?
Yeah, and just to kind of coattail on what Devar and Michael were saying, but what I see the problems, the 2 or 3 problems. One is just the rate of implementation. I mean, we talk about the fact that there is so much technology in the mortgage industry in the last 2-3 years, but let's be honest. I mean, how much of it have we actually implemented? Like, how many lenders can you go to who will confidently say that we have implemented this? That's one. 2 is a lot of these technology is still in infancy. We talk about blockchain. There's practically no blockchain in the mortgage industry. We can throw around the terms, but you look at artificial intelligence, there's practically zero artificial intelligence, very little. So we throw around the term saying these are game changers, but let's be really honest. We have done nothing in terms of blockchain, in terms of artificial intelligence. Machine learning, yes. RPA, yes. OCR, yes. But even look at something as basic as OCR, right? I mean, you extract certain information from your pay stub, you get it right the first time, you get it wrong the second time. The confidence level in these technologies is not at a point where if I was the head of underwriting, I'll say, let OCR do all the extraction and our underwriters don't need to touch it. So everything still needs that second level of evaluation, second level of escalation, practically 100% right now. But as the technologies mature and as we see more implementation, and one leads to the other, by the way, until the technologies don't mature and people don't have confidence in it, we will not see the level of implementation and adoption that we want to. But once we get to that level, I can guarantee you we will see a lower cost of production, but that could take another 2 to 3 years.
And would you all agree, or I guess I'll just throw my own theory there. I do think over the last couple of years, when the industry was standing in a money machine, it was very easy to say, oh yeah, let's try some of this and try some of this. However, a lot of the effort and focus on everything had to be about just getting deals done, right? How do you keep that manufacturing process going? How do you get people to the closing? And so you start to think about some of these solutions that, yes, are there to save time and to save money. But when you're buried in money, that's not your immediate concern. Is how do we refine this process? So I do think that it's also you touched on implementation and adoption, and that's something that's very near and dear to my heart. And I would encourage people, like I think that this is a good time for people to be looking hard at their tech stack. What do they have? How are things integrated together? Working with your technology partners and saying, hey, help me. How do I make sure that I'm getting the most out of this? But giving them the opportunity to do that, because I think, as a lot of lenders weren't asking much over the last couple of years because you didn't, perhaps need to, but now is the time to, kind of sharpen those blades. But Josh, I want to turn to you and get your thoughts, particularly from the, again, the vendor side of the equation. What would you say?
Yeah, I mean, I think the first part of this is our industry right now, or has been, driven by production, not necessarily profitability. Because everyone knew that if we drove production numbers over the last 2-3 years, that they'd be profitable. So there wasn't that focus. As you said, it was more about throwing bodies at it. And if, we can close more loans, we know we're going to make more money. And that was true, but that's obviously definitely changed. Another thing with the technology, I think just in general, our industry has just been very slow to adopt new technology, right? I mean, you look at, I got in the industry in 1999. They're still using software and systems that were built in, the 90s. And a lot has changed. And it's hard to think that lenders are going to become more profitable or reduce their cost to produce loans doing the same thing the same way, right? So I think that's the big challenge right now and we're going to see this over the next 2 or 3 years as these new technologies like AI and just more advanced systems will take over the pace of the marketplace. Now, AI, as Shashank said, it's and everyone and Doar said it's still in its infancy. Those first lenders that go out there, and there are some lenders right now trying it, and some will win, some will fail, and then people will start following the pathway that where the winners go. So I think we will see that coming in a couple of years, but it's just we as an industry have been driven by production, by loan officers saying, I have a book of business and let me close your loans for you, not necessarily how do we systematically run a company and reach our consumers.
So I think we answered a lot of Tim's question. Is he talked about kind of why has technology not made an impact here? Is there any advice for those of you here on the panel for lenders that are out there looking at their tech stack, looking at their cost of doing a loan, looking to sharpen things up? Somebody want to offer some advice to the lenders that are looking at exactly this problem as to what to do?
I mean, I think if you're looking at some of these things like machine learning, like you see machine learning used for things like document classification. Like really look and see like what do you need it for? Understand that it's not going to be the blue pill that's going to solve everything, but figure out what it can actually do, and then ask your fellow lenders out there and see how they're actually using it and what's working, and then adopt that first.
That's good. Anybody else have some advice for the lenders listening on this front? Laura, how about you?
Yeah, one thing that I can add, and it seems simple, but I know it's an exercise that we've done, is going back to all of our vendors and our partners and making sure that we truly understand all of the different pieces that they have that are available to us. Because one of the gentlemen earlier mentioned that we're using all these different pieces and parts for a very specific part of the equation, front end, back end, somewhere in the manufacturing process. I think the more that we can bring into one house, or at least making sure that we're getting the most out of that relationship and that partnership, that also helps us win in the long term.
I will throw this out just as a thought. I think there's a lot of waste, and that is a reason why you see the price where it is today. I think everyone is using a net to try to get as many opportunities in, and you're going to get waste when you do that. And so I think focusing and looking at conversations with consumers and slowing things down a little bit, asking some questions. Does somebody actually need to go through this process? Or do you have an ambitious loan officer that's just like, I'm going to write every paper, right? It doesn't matter. And that is why we're seeing some of that price go up. So I think some focus, right? And a little bit of training with how to use your ears in conversations with borrowers. I think that will help. Just a little bit of grassroots will help lower that cost as well.
Yeah, and I think Bill Dallas said it best when he was asked this question about the cost of loans being so high, is that we in the mortgage industry, we make things more difficult. So as things get more difficult, you got to apply that technology. So, we need to start simplifying things so that way these technologies can actually be meaningful, or it can be used meaningfully.
Yeah, I think the problem that we see with mortgage industry and the adoption is the fact that when it's a busy year like 2020 and 2021, we are too busy to adopt technology. And when it's a bad year like 2022, we don't have the money to adopt technology, or we are focused more on cash flows. I think there has to be more consistent approach to technology adoption. You need to have teams. You need to have people who are tasked with technology adoption. And come what may, this is something that you're focused on. What we don't understand, we started the conversation saying that these are supposed to be, as Davar mentioned, a blue pill that will change everything. But that's not what it is. We have seen it. I mean, these technologies have been there for 3-4 years, and we know that that's not what it is. If that's not what it is, then we need to have longer term view of this. This is not getting a branch on and starting production next month and getting money out of this. That's not going to happen. And I think that's where we struggle as an industry, is because we have this mindset of let's do something which can produce revenue 3 months down the road or 2 months down the road. And this is not going to do that. So I think it also requires, other than everything else that my esteemed panelists mentioned, is just a change of mindset to the fact that we need to have a long-term view of this to produce some real significant results.
Before we move on from this question, that was great advice there. But I would add to that as well. Just again, my own thought on this is that I think it's important not to look at the perceived adoption levels or engagement or logins or what have you over the last 2 years and say, oh gosh, this isn't worth anything. Nobody's using it, right? Because there are many things people didn't have the time to use or didn't need to use because they had more than enough business. And it may be a solution that you need more than ever right now, especially if you are looking at staffing changes and some of the other things that we're going to be talking about in a moment. And I also think, to your very good point, it's important how you lead. How are you leading your team to adoption? Are you saying, gosh, I'm scared of you, will you please try this thing that we've invested a ton of money in? Are you saying, hey, this is what we're going to do as a company because this is going to make us all better? It's very easy to lead when times are good because you kind of just sit back and cheer everybody on, but right now is when real leadership actually shows up. So on that note, let's move on to our next question from the wonderful Suzanne Livingston of RWM Home Loans, who asks this question. She said, we are all slowly automating our processes, but we do want to know how companies are measuring the ROI of this shift. So very related to what we were just talking about. For example, if someone automates LPDU underwriting, how do you quantify money saved on time, property inspection waivers, PIWS, fewer conditions to chase, and quicker turn times? So good question. So she's asking all about how do you measure ROI, and that is definitely something I hear as I'm going out talking to lenders. So Shashank, I'm going to start with you on this one. You're a lender. How would you answer Suzanne's question?
Yeah, the way we are tracking ROI on our technology adoptions right now is really two things. One is the improved turn time, and second is the amount of time that our ops team is spending on a certain process. So we are keeping it simple, which in turn, of course, result into financial benefits. But really, as of now, we are tracking those two metrics to see what's going on. For example, for our servicing team, we had a process before where someone in the team will go and check every single email. We'll send one email at a time saying your first payment is due at whatever time, and we are not a servicer, so it wasn't a lot of work. But then we implemented robotic process automation called RPA, where a bot will pick the batch file, will send an email to everyone, we'll look at the data from our LOS, and we'll do that. And we tracked how much time the person in the servicing team was taking to do this before, how much time the bot is taking, how much the bot is costing to do that, versus in terms of number of hours spent on that, how much would we paying that say human team member to do that. That's one way of tracking it. So it helps both in terms of his speed, because now you can get done what used to take 2 days in about 20 to 30 minutes in some cases. Second, with consumer experience, now you're getting a much faster response out to them. And third, of course, in cost saving, which we are not exactly tracking in dollar terms. Same with our auto conditioning process, is that when the file comes in, under half the condition that underwriters put on their underwriting condition sheet is kind of understandable. It happens almost 100% of the time. If it's a condo, you need a review. If it's a non-permanent resident, you need a visa or a green card. There are tons of conditions that are kind of automatic. Underwriters don't even need to think about it. There are some which are much more evolved. You need to look at business tax returns, and then you have to. Those are very evolved conditions. So what we have done at InstaMortgage is to look at really the low-hanging fruits first. Because when you adopt technology, you want to build on the complexity and not start with something very complex, where you get frustrated very quickly and you don't see the adoption because they're like, this is not underwriting the entire file the way we expected it to, because we don't want it to. We only wanted to underwrite what are the easy conditions to begin with. So now when the file goes to an underwriter, there are like 10 conditions already pre-populated. In fact, the processor sees it even before it goes to the underwriter, giving them the opportunity to work on those conditions even before. So that's what my recommendation would be, is that tackle low-hanging fruits first if you're looking at adopting some of these technologies. The way we run into problems is that we try to solve some of our hardest problems first, and that leads to frustration. That leads to the fact that there is no ROI on this because the underwriters are still looking at this because you thought this will automate it, but this is not. And so that's how we are doing it. Of course, it may not work for everyone, but all that we are looking for right now is improved turn time and how much time it's saving for our team members.
Well, Josh, you talk to a lot of lenders out there, so weigh in with what do you talk to your customers about?
I think to Shashank's comments, really, I think there's a lot of things that lenders have to do to understand ROI. I think what you had said is you time or you see how often a task takes somebody. I was a lender for years, and I remember I gave all my processors, underwriters, setup folks, everyone, coordinators, I gave them a little timer, stopwatch. And I said to them, hey, listen, I'm not trying to micromanage your job, but what I am trying to do is understand what you spend your time doing, so we can then figure out what's the low-hanging fruit to tackle. To your point, no, you don't have to go after the hardest problem, right? You go after, hey, I can save a day here, I can save 2 days here, I can save 6 hours. And then all of a sudden, a way to track ROI is what's your cost to produce? Is it going down? How much does it cost you to order an appraisal? There's a cost right now to your company. You can go figure that out. And if you automate it, how much does it cost now to order an appraisal? So taking all these like little micro, steps and looking at everything, I think is where how you measure ROI is, process by process. And then there's like what I call soft ROI. There's an intrinsic value of closing a loan faster and having less conditions to the consumer. You have a higher pull through, right? I think people need to know that. We have done a study in the past with our lenders and our lenders' data that for every day sooner they closed a loan on average, that was 1% more than they closed their pipeline pull through. So our lenders averaged like 67%, and I think they averaged like 34 days. If they did it at 33 days, they'd 65%. If they did it at 24 days, they did it at 75%. So there was an actual one-to-one correlation between time to close and pull through. So I think lenders start tracking those things, and that's really what it comes down to.
Right on. And it's interesting, having spent a lot of time thinking about ROI. It also, it's not as, I think we all know it's hard, right? Because it's not just, X happens, we engage with this technology and suddenly we're closing more loans. I mean, it's otherwise any technology that anyone bought at the beginning of 2020, they would be like, look what we did. We quadrupled your production. I find that a lot when you start talking about ROI and say, well, how much does this time take? How much does this, cost you right now? People are like, I don't know. So I think that's a good thing that will happen in the industry right now is people are being forced to really sit down and say, okay, we need to really know our numbers so that we know what we should expect, what's our baseline that we should be improving from for now. Dewar, I do want to turn the same question to you. So
yeah, so I mean, if I could just Josh and Shashank and yourself, you said you measure ROI by the number of successful underwritten loans. You can quantify money saved on time, PIWs, fewer conditions to chase, and quicker turn times. The more successful loans you have, the higher your ROI will be. You can also save money on staff costs by automating processes. You'll be able to get more work done in less time, which will save you money. So these are all the things that have been said. So automating processes can help you improve quality. You'll be able to catch errors and mistakes more quickly, which will save you time and money in the long run. In short, there are many ways to measure the ROI of automation, but the key is to find the method that works best for your company.
Well, we're going to turn it right back to Josh for a second. To finish your thought, you had a great thought talking about, really looking at knowing your numbers, knowing where you stand.
Benchmarking. Yeah, I think that's great. It's a great way to understand what you're doing is to benchmark yourself. And then you can understand where to improve. And I think that's the easiest way to, look at it. We did something similar with our marketing platform. Like you said, Sue, any technology provider could have said to the lenders, look at my technology is giving you a great lift. And so what we did is we actually benchmarked our own lenders against one another, and we benchmarked them against what feature sets they were using. And we found that some of our feature sets, like our engagement platform, increased conversions 200-300%. It was astonishing by benchmarking our own lenders. And so that's something I think you as a lender should do, benchmark yourself against other people, and maybe ask your technology vendor, hey, what am I using? What am I not using? What are people using that's making them more successful? I think that's also a really good way to find out how to do this.
Absolutely agree with that. What a great point. Let's move on to our next question. We've got a lot of wood to chop. Unless anybody has anything more that they want to share.
Two quick thoughts. First of all, Josh, what you just said is brilliant. We too believe in that philosophy, and everyone listening, you should be working with your partners to benchmark and see how do we rank compared to others using your same system? Like, where are we? Like, brilliant. We love it. So, Josh, I love that you said that. And Duar, I just want to just compliment you on, and I wrote it down. The more successful loans you put through, the higher the ROI. I think that is so important. It goes back to the first conversation. Waste, not focus, right? So don't do every loan. Let me rephrase this. Don't think every borrower is a loan today. Do every loan that can be done, but don't think every borrower is a loan today, and you will increase your ROI.
So let's go to our next question here from Luke Ziegenmeyer, who asks a great question here, saying, during this time of reduced volume, how are you looking at balancing your staff reductions down to current production levels while still ensuring that you're prepared for the market when it does eventually turn? So this is really a question for the lenders. And Shashank, we're going to start with you to tackle this.
Sure. Yeah, this is a tough one for sure, and very real to what's going on right now. There are two sides to that question. One, how do you adjust to the current production level, and what do you do when the markets turn? And those two, the answers to those questions will really drive what you want to do. So first, what's your current production level? Like, are you 20% down? Are you 60? Are you 90? Of course, different stages of your production will force you to take different kind of actions. If you're just moderately down, you can have some of the people go slightly reduced hours. We have worked with multiple things here. See, you might have to lay off certain people if that's what it is. But what we need to understand is, we also need to understand, when do you think the markets will turn? And that's a big question here, right? If you think markets will turn in 6 months, your strategy will be very different than what you think it will be in 18 months. And one of my favorite quotes is hope is not a strategy. So you should base your decisions based on the fact that, let's say, next 18 months remain like this. At least from an interest rate perspective, it remains elevated. The inventory does not come up as much as we think. Even if it does, affordability remains a problem, which it is right now. If that's the case, how do you want to plan for that? And what we have done is a mix of various things. But really what you're looking at is, if the volume goes back to 2018, 2019 level, which it is, then the salaries need to go back to that level. We cannot, I will not take numbers here, but we cannot be paying the team what we were paying in 2020, 2021 when they were working 15, 16, 17 hours a day, right? It's a very different environment. And mortgage industry has always kind of worked in a variable compensation type. The sales has always worked with variable compensation, which means the ops need to be more flexible to be doing something like that as well. And that's what we have done, is that, one, we have been very realistic about where we are, what kind of production levels have we gone down on. What we realistically project is what will happen. Because again, if you have something going on that you think 2023 will be significantly better than 2022, and you can hold on to some of those people for 5-6 months, I'm a strong believer of keeping your best guys for as long as you possibly can, even if it means bleeding in the short run. Is because bringing new people back in and training them, could take months, if not years, if some of those people. So I'm a strong believer of keeping my best people for very long. But at the same time, you need to survive for them to stay with you. So it's a balance that you need to have. And that's a conversation. It needs to be very honest and open conversation with your team, saying, hey, here is where we are. Here is where we think the market is going. Here's where we think we will be going. And we need to help each other out here. Just like you got the benefits and we got the benefits when the market were at the peak. We are we are hurting right now, and so we need to share that burden. But what my team has really has appreciated the fact that we have done everything not to lay them off, so that they still have an employment, even if it means reduced hours in some cases, even if it moving some of the compensation from fixed to variable. And I think that's what we should be looking at for as long as possible. But at the same time, also working on how do we improve the market conditions for ourselves. And that probably is in a different question on what loan officers and leadership should be doing. Hopefully there's a question around that. But that's another thing that a lot of lenders can do, is to figure out a way of how we can improve from where we are, how we can create some of the inventory, how we can create some of the borrowers who are not affording to buy a home to. It's like creating a market of your own by creating some of the products, by creating some of the loan options that does not exist because we are not selling just your FHA, VA, Freddie, Fannie anymore. We have to be more creative around it. And the more borrowers we can help, the more business it brings, which means it gives us more opportunity to retain some of those staff that we otherwise will have to let go. So again, I said it's a tough question, but hopefully that helps.
A great point. Laura, I want to turn to you. How are you looking at this very tough topic right now at Mountain West?
No, I think there's a lot that goes in it, and I mean, I think all of us are very cognizant of our bottom line. You know, everyone's doing the best they can to kind of tread water in an uncertain and tumultuous environment for sure. I think we share a lot of the same philosophies as Shashank was mentioning, as far as investing in your people, making sure that you're retaining and having open and transparent conversations with your team about where we are, about where our projections are, where we think the market's going, making some tough decisions in other cases as well, as far as what we need versus what is a nice to have feature, or nice to have partnership, or nice to have vendor option, or nice to have team member in some cases. But the big thing with that is making sure that we have the right people in place that not only serve us today, but as the market does shift, making sure that we have the right partnerships in place. So in our case, we have a little bit more of a variable help as we need it, because you know one of my least favorite things, I'm sure everyone's least favorite thing, is having to say goodbye in some cases to team members who are near and dear to us, who we've worked together for so long, or whose their family works for you. I mean, there's so many good parts to building a strong culture and a family atmosphere in a company, and that's something I think that we all take really to heart, is that we want to make sure that we honor those and are doing the right thing for the right reasons.
Yep, and I think as always, treating those folks with respect, giving them a good path. Yeah, I've heard some lenders share. Some of these are tough conversations, but you also have to let processors know it's not normal to make $250,000 as a processor. So, so there's tough conversations. There's level setting, because these are real people with, real lives and real mortgages to pay. I think one of the good things about the climate that we're in is there are other jobs to go to. I mean, the job market is still extremely healthy despite, some of the craziness going on in the world. So there are, I think, as you said, treating them with a lot of respect and care, even though you do need to make a change, just being a responsible business owner. So, Michael, I want to hop over to you. Talk a little bit about how you're looking at this at APM.
Yeah, I mean, everyone else hit on, some of the same exact points as us. Luckily, for us, our leadership has always kept a certain percentage of kind of flexible and elastic, workforce. So we're able to use some of those levers, during this, from, contract resources, outsourcing that we were able to pull back in completely in-house, so that it was a less of an impact, to our home office employees. Some of the other things that we did too is, not just looking at just, metrics as far as, units, but, we do a lot of surveys to our branches, to our customers, kind of on, their experience with really different people within the organization. So also taking that into consideration as well, right? When you are having to make some of those tough cuts where, hey, maybe this person's a little bit more middle of the road as far as, the units they're pushing out, but they're absolutely number one, in the experience that they provide to, our branches. And that's one of our things, is really, around creating experiences that matter. So taking that into account as we, do these evaluations and have these tough conversations, but also just the transparency from the leadership level. Throughout this, we've been having conversations dating back to last October and November, kind of predicting where the market was heading, having those conversations as early as we could even, nobody forecasted, I think, for exactly what happened. But, just really having, as soon as we knew, everyone knew. So if they did need to make decisions to put themselves in a better situation for their family, we wanted them to have the absolute most of a heads up that they could.
Yep. And I think we've, hindsight's always 20/20, to your point, but I think, always being prepared so that you can be transparent, to your good point, to be respectful of your, your staff that might be moving on. Any other advice that folks want to add on this issue? It is kind of it's more of a lender issue more than anything. But I think you've all shared some really good thoughtful guidance there. Couple other things we're going to cover before we wrap up. This next question comes from Donnie Jordan of NotarizeMeRemote.com, and he's asking, why does the mortgage industry still have resistance to RON transactions? By the way, acronyms. We are acronyms galore, and we've talked about RPAs and PIWS, and now we've got RON. Alex, I got to ask you, what did you share about what you're doing in your company right now?
Yeah, no, if there's more than two people on a call, there's no more acronyms. You say exactly what it is. Because when you're on a call with just one person and you say an acronym, and somebody's like, what's that mean? No problem. But as soon as there's four people on a call, people are like, I should know this. So, so this, I think, what is this? It's some kind of automation, right? Remote automation notary, something like that?
It's a
There you go.
remote online notary, as I believe I had to learn this one, so I got this one right. But Donnie's good question is, talking about why does the mortgage industry still seem to have resistance to RON transactions versus traditional ink and paper signings? That's the first part of his question. Second part of his question is, what are the biggest anxieties regarding remote online notarization since the House committee passed new legislation? So a lot to unpack there. Laura, let's come to you first. Why, first of all, do you think the mortgage industry has some resistance to RON transactions?
Well, I mean, I think as an industry, we're not known for being cutting edge on adoption of technology. I mean, we're in the business, so to speak, of motivating and influencing people to make changes to their business. So the first thing that we're looking at is we have to be able to educate and show people that this is the better way, the easier way, the optimal way for their borrowers, because at the end of the day, our originators are concerned first and foremost about the experience of the borrowers, and they don't want to put their name on anything that could go sideways or skew or slow down the process. So there's a lot of, I would say, fear on that. But really, I think more from the lender side is there's a lot of other pieces that go into it. We did have some legislation that went in that allows us, at least in California, to use a notary outside of California to complete a RON transaction. However, many of our warehouse investors, our counties are not yet accepting e-notes. So really, I think there's a little bit more acceptance in what's perceived out there. I think we just don't have the proper ways of delivering them. I know in our case in particular, we kind of looked at it as a crawl, walk, run approach. We're doing a lot of hybrids. Those are going really well. I think we're doing hybrids on 87 to 89% of our transactions right now. So again, to the comment that I think the mortgage industry isn't adopting it, I don't think that's quite what it is. I think we need to get our ancillary folks involved. And that's, again, the county recorders, our warehouse lines, our investors, the people who have to accept the e-note. They're not there yet. So that's probably first and foremost, I think, what's slowing us down out of the gate.
Okay, that's good. I mean, I think that's good, especially I think Donnie is from one of those companies. I'm guessing from his company name, and so I think that's a good note, is to get more knowledge and education out there about how do we pull together all these forces. You'd like to adopt something to be able to save some time, maybe create a better experience, but everybody's got to be on the same page with it. That's a really great point.
Sue, I got on this. I think again, I've been in the industry since '99. For me, one of the reasons I've seen lenders slow to adopt new technology, new ways of doing business is just the fear of what goes wrong, right? Laura, you named it. Some warehouse lenders don't allow it because they're not educated on it, so they're not going to let you sell it to them. Because the warehouse lender says, well, if you're on my line and this loan doesn't get bought, I don't know how to deal with the raw, I don't know how to deal with this. And really where this comes from, if you're in the industry through the 2005, 2010, I was a direct lender. Let me tell you something. The amount of loan buybacks that got sent to us for 2008, 9, and 10 for Fannie Freddie guidelines. Like, these were Fannie Freddie guidelines that said, appraisal waiver, income documentation waiver. Then they'd come back and say, oh, we actually went ahead and pulled the tax returns. They didn't make as much as they said. And our response was, well, you didn't ask us to verify that. You asked us to not verify anything. And they pushed it down our throats. We had to buy it back. So I think that there's a trust factor of no one wants to get stuck with loans. No one wants to get stuck with loans anymore. So it's going to require education, right? All lenders are going to, like Lori said, run or walk, crawl, walk, run. Education. Everyone has to know it, right? Everyone's going to have to learn how to know what it is. And this is not just for RON. This is for everything in our industry, right? This is for income or asset verification, work number, all these technologies. It's just a trust factor. Like, we have to understand that we can sell these loans. Like Fannie Freddie's not going to push them back down our throat, right? Or if there's ever an uptick in foreclosure or something. And then the other thing is, let's just be honest, our government was built to run slow and to slowly make changes slow, not fast. We don't always want our government to make fast changes. But I think we're at a place now with something like this, we're beyond it can be a fast change. We can go ahead and push this one through, I think.
Yeah, I also think there's an infrastructure problem with Ron. As Laura mentioned, it's not just us lenders not wanting it. In fact, I've been trying to push Ron at our company for a long period of time, and have found resistance with practically everybody else. The warehouse won't allow it. Our investors won't buy it. Counties don't record it. Customers don't want to do Ron. I mean, they have this feeling of why shouldn't I be doing in person, and then I can ask the questions that I want to instead of remotely doing it. Sometimes loan officers don't want it because they want to be at closing with their borrowers, like in person, and meeting their realtors in person at closing. So I on this one at least, I mean, I know that our industry has been behind on some of the technology adoption, as Josh and Devar had mentioned before. But on this one, I see that it's a real infrastructure problem, is because this is not just us pushing Ron. It's like the entire infrastructure needs to come together, from government bodies to warehouse to investors to us to borrowers to realtors, and that's going to take some serious changes. And they don't see any real benefit, really. At the end of the day, you're probably saving $25-$30 on notary. You're saving maybe a trip to a title company. There are like mobile notaries that go to people's homes, so it's not that inconvenient, really. So at the end of the day, it's like, unless I'm traveling to Mexico and I need to sign papers, then I get it, that I need it. Other than that, there's not a huge amount of value add that you're bringing in for an entire change in infrastructure. And I guess that's where the problem is in terms of adoption.
That's a great point also during the in-purchase market. I forget who just said this, but a loan officer saying, hey, right now I need to maximize that time with the real estate agent, with the borrower. Like, I can kind of understand. So who else? Alex, you want to weigh in on this? Quick.
Yeah, there's some impact that needs to be considered with like the state and county protecting its employees, right? Its job and workforce, and so I think that has a lot to do with it as well. And I don't think it can be overlooked. I think that's one of the other reasons why you're not seeing such massive adoption and execution throughout the country. So I think that's just an important part of it. That some things are out of this lender's control, right? And so just consider that as well.
I will say, Sue, just kind of one more little piece is, I know we've gone through the process, but I think in today's market, just as kind of a peek behind the curtain, I know Shank mentioned as well, we have to know which investors will accept, which warehouse banks will allow it. So we've actually gone through and we have done a couple full e-note, full e-closings. That being said, in today's market, many of us are using a pricing structure of Best X. So if you don't know where that loan is going to go and you can't ensure it's going on a warehouse line and it's going to an investor who's going to support that, that's going to be another thing that's going to slow down the adoption, I think, of eNote as a whole. And that's just, again, that's a market condition.
Yeah, it's an interesting point because I've talked to some vendors, solution providers, where I've encouraged, like, your pitch right now shouldn't be all about speed. It's not all about like, how do we get them closed quick? It's, in a purchase transaction, you get them closed when you need to get them closed based on what the data is on the purchase agreement. It's not like churn and burn, get them through, as fast as you can so I can move on to the next one. Like, take speed out of your, that's not necessarily always the thing anymore. So I think those are very interesting points. Before we move on to our next question, I did want to mention, we've talked a number of times throughout this conversation about adoption and kind of the lack of, how our industry can be slow to adopt, and particularly when you look at the last couple of years, I think it's been tough for people to adopt. And I do have an article that I'd encourage you to look up on stratmoregroup.com that I wrote on this topic. It's one of my favorite articles I've ever written, because it's basically a playbook on, not just the why I think some of this has happened, but having been in the belly of the beast on exactly this issue, I know, kind of some of the tricks of the trade. So I'd encourage you to look that up on stratmoregroup.com, or you can just find me on LinkedIn or shoot me an email, and I'd be happy to send you a direct copy of it as well. Our last question that we have here, before we're going to run out of time in a few minutes here, this is flown by, but this is a great, great question. And this comes from Jason Hultgren, good old Jason at United Community Bank. So he asks, using high tech and in-person high touch, what is the best mix of sales activities for MLOs to implement right now to build relationships with realtors, builders, and referral partners? And Alex, I'm going to come to you first. I know you've got a lot to say on this topic, so lay it on us.
Yeah, I mean, look, it's if this is and the way I understood this question, Sue, it's all about what are some of the best practices in this environment for originators to be building their communities up right now, their referral communities. And I mean, you've all heard me say this before, I think. I'm a big believer in giving to get, right? If you want to build a referral network, if you want to build a community, an ecosystem, you want to be able to give, and you can't just hope that all of your referral partners will be the reason why you make a bunch of money and a bunch of deals this year. You want to work together and find ways to give back to them. And it's important too to understand, and I'll give some specifics in just a second. It's important also to understand that your referral network or your referral partners aren't just agents, right? You keep hearing, and I think a lot of you have heard Dave Savage say this, like be the captain of the wealth team. Well, does everyone know what the wealth team is made of, right? It's people are like, oh, captain of the wealth team, so just my mortgage company, right? No, the wealth team is your accountant, your insurance, your financial advisors if they exist out there, attorneys. Um, all of these people are part of the wealth team, right? You can be the captain of it, but don't forget there is a team. And so you want to make sure that you're constantly reaching out to all of them. And by the way, people are like, how do I find some of these people? Well, you could start by asking your borrower, who do you use? Do you have any of the? Who do you use for insurance? Who do you use for accounting? Who do you use for financial? Like, ask. Great. Can I get an introduction? I have lots of people that might want his services as well, her services as well, right? And so, number one is that. Like, again, remember we talked about use your ears a lot, a lot. Right now is a great time to practice that skill. Listen, 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 listen. Ask and listen. Ask and listen. Okay. Now, the other important piece of it is to give back. Is you have to have something to give back. So right, managing your relationships, managing having systems like Accelerate and having processes in place for that, so that you're reaching out and keeping on in touch with your customer base, but also insights, intelligence, strategies, and insights that help you help your not just consumer, but also your referral partners, right? There's insights you can get that may not be a call to the borrower to say, hey, I got a loan for you. There might be an insight that you're reaching out to the accountant first. That's the first touch, right? And so using all of those tools that you have available to you is how you build a great referral network. But remember, give, 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 give. Stop asking, start giving. And by the way, if you want a very healthy referral network, if you want a really healthy flow of business, stop working with everyone. Work with like-minded people who believe what you believe. Because if you have 100 referral partners, but you get one, or two of them referring business, and the other 98 of them are just, in your database, that's not a referral network. So focus it down. Find people that you're going to be constantly communicating with and adding value to their lives as they add value to your life. So that would be my 5 cents.
You can tell you're a tiny bit passionate about this, which which, which I love. You said so many great things in there that are so important. There are so many different referral partners to tap into. And to your point, that's what the wealth team actually looks like. And I love what you said about, reach out to your past borrowers that you closed. Oh, those are great phone calls. Call the people you closed over the last couple of years that have rates with a 2 handle, a 3 handle, right? Like congratulate them, high five, and ask them those questions about, man, I enjoyed working with you so much. I'd love to, have some great professionals that you might work with that I could refer to some of my other customers, because whatever they answer, you win. Either you get an introduction to a great, CPA, a wealth planner, what have you, or if they say, gosh, no, I don't have anybody, you've got the great opportunity to make a referral to somebody else that's in your network. So that's brilliant, Alex. Laura, I want to turn over to you and get your thoughts on this. I mean, as you look at kind of the high tech, high touch, what are you seeing some of your loan officers doing that is really successful right now?
It's interesting in a lot of ways. A lot of my originators are going, what I'll say, back to basics. And I think the big thing is being consistent with being out in front of people, whether that's virtual or in person, or or a hybrid of both of those. I think the methodology of how we're getting out there, so to speak, has changed. I have some who are very prolific on social media and are providing that value that Alex was talking about and giving information and tips and just becoming that local expert on all things involving their community. So not necessarily just mortgages. They're not pigeonholed in that. Not that they're selling other things, but that they're becoming a local community expert. When someone says, hey, who's the best baker in town, tailor, tax preparer, that they're just that knowledgeable source that everybody goes to. And they're doing that through mixers, networking events, social media. But a lot of them, I would say, are using exactly what Alex was talking about, which is giving that value to people, knowing that whatever you give comes back to you tenfold. I think, again, the difference that I'm seeing this time around is how varied the approach is. In the past, it was always just going and doing open houses in person, going to caravans, going to realtor groups, going to IMB meetings and those type of things, and now it's a lot more of a hybrid of the approach has changed, but the methodology is still there.
Well, people are still people at the end of the day, right? And I often say people do business with people. People don't do business with just a generic brand. They do business with a person. It's interesting, even as we're having this conversation, this is a different conversation if you're actually watching this, because we can see each other and we can look at each other's eyes and facial expressions. And so whether you're doing that digitally or doing that live, getting into your community, which is another great word that you used, making that human connection, because people do business with people, especially when you're talking about purchasing a home, big life event like that. So, Michael, I want to turn to you. What are you seeing your loan officers doing that's really working out there in the market?
Yeah, I think it's just really kind of revisiting their why, right? I think using that, their why, their unique value proposition that they have for those agents, like what Laura talked about, like what Alex touched on, and then really allowing that technology to help support that. It's not leading with the technology, because to your point, people want to do business with people, but it's also, using those technology platforms, the automation that we have in place, the follow-ups, whether it's, different types of drip campaigns, flyers, anything that you're doing to support those relationships with your agents or referral partners, leveraging, that technology, but really leading with the you part of it first. I think that's right. How many things do we get in our inboxes where it's just, email that's just random stuff that we don't actually pay attention to? But when that person picks up the phone and calls us, whether we're interested or not, you leave them on the phone a little bit longer than you pay attention to that email. So I think it goes back to the, just that human interaction, piece of it.
Absolutely. And finding ways to do that at scale. It's why I'm such a huge fan of video as well. Shashank, is there anything that you would like to talk about with this?
Yeah, sure. Other than leading Insta Mortgage, I'm also one of the top producing loan officers. So I regularly mentor my salespeople into what they should be doing. And one of the things that I teach them is not to lead with or assume any solutions going in. Don't talk about yourself, like this is what Insta does, this is what I do. In the first meeting, utilize the entire meeting to understand what their problems and challenges are. That's a very customized approach that I have personally done that, of course, in my loan officer career, and I teach them, is that don't go bragging about yourself or your company or anything really, because you could have a huge amount of experience or solutions into a problem that's not even their problem. Like their problem could be that I have a huge pool of buyers, but they can't afford homes. Like, will seller buy down strategy work for them? But again, you're not coming up with solutions saying I have seller buy down strategy, and they're like, we are a listing agent, so we don't really care, whatever it is. So I always encourage them that use the first meeting, first of all, to understand their problems and set up the second meeting. And you don't always need to have the solution to the problem. There could be a book, there could be article. You mentioned about an article, Sue, that you wrote about tech adoption. It could be an article, it could be a video by somebody else. It could be your boss who can tell you what the solution is. Solutions can be found, but you need to understand the problem first. And that helps you set up the second meeting. That helps you come up with a solution the second time around. And now you are in the front of the line of all the other loan officers who are queuing up to work with this realtor. is because you really spent the time to understand what the problem was and actually came up with a solution, even though you were probably not a master at it. That's what I did for first. I mean, some of you know that I started in the mortgage business in 2008 as a recent immigrant with $1,900 and went on to become the top 200 loan officer in 5 years. This is some of my most important strategies that I've used in the first few years to build that referral relationship with realtors and CPA and financial planners, is to really do that one-on-one, and then you scale it up in doing a small events or doing email follow-ups or text drops or videos that, I mean, Sue, Michael, Laura, all of you mentioned about. But it starts with that one-on-one approach, because you only need about 10, 12, 15 solid referral partnership to have a very consistent production level.
So I just have to comment on the fact that you got into the business in 2008. This is one of the things that I love about you and your story. I'm serious, because I've said to people recently, it is markets like this that we're in right now when the great businesses out there and the great originators out there were forged and founded and made. It was not in the heydays when anybody with the pulse can do loans. It was times just like this, and you are living proof and example of that. So cheers to you. Seriously, and thanks for that encouragement for everybody. Josh, I know you've got some comments on this, so before we've got a couple minutes before we close it out here. What do you got for us?
I mean, I think everyone's had some really great points. I think, for me, it's add value. It's just really what it is. And to Shashank said, ask them what do they need help with, right? That's just really what it comes down to. Because if, when I was a lender and we hired new employees, their new employee orientation day, I came in to say hello to everyone. And the first thing I asked everyone was, what industry are we in? And I'd ask everyone what industry we're in. And you get all kinds of answers, and really almost never the right answer, which is we're in the services industry. It happens to be financial services, but the service industry, therefore we get paid for service. That's what we get paid for. So we really have to embrace that, I think, is we get paid for service. So that may mean listening to the realtor and figuring out what they need help with, like you said, Shashank, or giving them some tools, giving them the ability to help market with them. Or, one thing we've seen what some of our lenders are doing, realtors are usually not great with following up with all their prospects. We saw something, it's like the average realtor gets like 20 referrals a month, but they only really talk to 18 of them they throw in the trash, if you will. That's an easy service. Hey, listen, you're not going to talk to all these people. We'll do it for you. Just give us their information. We'll put it in the system. We'll help you. We'll give you something of value. And if any of them bubble up to buy a house, we're calling you right away. So it's just give service, right? And that's really what it comes down to. Be the expert and give great service.
I love it. And this is why I love Mortgage Innovators and this group, is because you just gave like an hour of unbelievable value, real ideas, real tactics that people can take out, utilize right away, share with their teams. So I appreciate that. So I do want to thank you all that are on this call, first of all, to our wonderful panelists who joined this conversation today, as well as everybody that did tune in, and those of you that sent in questions as well. Great questions that came in from our audience. So for more engaging conversations similar to what you watched today, I want to invite you to check out the Mortgage Innovators podcast for weekly discussions about all things mortgage, current trends, and the innovation that is propelling the industry forward. But before we say goodbye, I do want to ask all of you listening to get out your calendar and save the dates for June 14th and 15th, 2023. Yes, we plan ahead at the California Mortgage Bankers Association. We're already wanting to get you booked for next June. But next June, 14th and 15th, 2023, it's Innovators Unite. And this is the Mortgage Innovators Conference returning in 2023 to the Hilton Anaheim. And there'll be hundreds of forward-thinking mortgage professionals for the industry's very favorite technology and innovation conference. If you want more information about it as you block out that calendar, visit mortgageinnovators.com/conference, and you'll definitely see me there, as well as probably a lot of the folks that are on this call as well. So thanks to all of you for joining and listening in today, and thanks most importantly to all of you great experts who joined the call today. So with that, goodbye from all of us at Mortgage Innovators. Take care, everybody.